Hello, everyone. Welcome back to another episode of Boss Economics World with Boss, where we lift the curtain on the absurdities of today's economic management. Today, we're diving deep into the November U.S. labor market report, but don't worry, we'll pull no punches in dissecting the bitter truth behind those already weary numbers. You're with me, boss. Are you ready? Let's kick things off with the headline numbers. The U.S. economy added 227,000 non-farm jobs in November, and at first glance, that might look like great news, better than expectations. But wait a second. Look closer, and things aren't as rosy as they appear. The unemployment rate ticked up to 4.2%, and long-term joblessness, when people have been unemployed for 27 weeks or more, hit its highest level in nearly 3 years. Now, some might say this is just a moderate softening of the labor market, but folks, that excuse has been worn paper-thin over the past few months. The question isn't whether the labor market is cooling or stabilizing. It's about how the underlying distortions created by poor economic policymaking have led to these latest figures, and why they're more than just statistical noise. Let's break it down, from a bird's-eye view to granular specifics, and discuss what these labor numbers really tell us about the economy, inflation, wages, and the deeper structural problems plaguing American capitalism. Sure, adding 227,000 jobs sounds like a positive on paper. Compared to a stormy October riddled with hurricanes and strikes, when payrolls only grew by a dismal 36,000 jobs, this month looks like an improvement. However, smoothing out that storm-related volatility reveals a worrying trend. Over the past 3 months, jobs growth has only averaged about 173,000, far below the buoyant pace of job creation seen earlier in 2023, when growth hovered closer to 250,000. This deceleration is no accident. It's the result of broader weaknesses in economic demand and the growing uncertainty facing businesses. You've seen the striking slowdown in hiring across most sectors, right? Despite notable gains in areas like healthcare, social assistance, leisure, and hospitality, some critical sectors like retail trade got slashed, losing the most jobs in over a year. That's a red flag, people. And for those of you thinking the Boeing strike ending with 32,000 jobs back on the books is a sign of long-term recovery, guess again. It's more like plugging a hole in a sinking ship and calling it progress. Let's talk about the unemployment rate rising to 4.2% with long-term joblessness surging. Temporary layoffs aren't the issue now, this is at its core a structural problem. Permanent job losses keep piling up, while more people voluntarily quit, hoping that the Great Resignation would provide a better opportunity. But here's the bitterness, they aren't finding new jobs as fast as before. The crux of the matter is, it's getting harder for unemployed workers to re-enter the workforce. There's no getting around the fact that the number of people unemployed for at least 27 weeks has hit a 3-year high, and that tells us two things: wages aren't high enough to lure them back, and businesses aren't clamoring to hire anymore. Long story short, serious cracks are forming under the seemingly solid labor market. And guess what? Inflation is far from in check. The Federal Reserve's monetary policy only went into easing mode deep into 2023, with Central Bank Chair Jerome Powell's first interest rate cut back in September sending a strong signal, but it isn't enough to loosen the tightening grip around employers, workers, or consumers. Wages, the holy grail of recovery, right? Nope, not really. While average hourly earnings for U.S. workers increased 4% from a year ago, we need to look at the bigger picture. For those who didn't catch it, that 4% growth has stagnated for the second month. Wage growth for the non-managerial workers who form a majority of the labor force moved up by a miserable 0.3% since October, and with inflation persistent around 3% to 4%, that's barely enough to stay ahead. Now, this flattening of wage growth reflects two clear underlying problems. 1. Excess labor supply. There's still a substantial pool of available workers sitting on the sideline. Companies don't have to worry about a shortage of job seekers, so there's little incentive to push wages higher or offer juicy new incentives like they were at the pandemic's peak. Got a pipeline of desperate workers? Pay them crumbs, corporate logic. 2. Declining business confidence. Businesses aren't sure the good times are gonna roll. They're hedging their bets in case further storms, be they economic or political, slow things down even more next year. What you're seeing is corporate belt-tightening at play. Next, we must confront the elephant in the room: how much of this can be tied directly to poor policy decisions? Let's talk about it. Fed policy. The Federal Reserve's rate cuts are doing little more than propping up a system that's limping along. Rather than addressing root causes like productivity issues, we're relying on blunt instruments like interest rate reductions and short-term fiscal injections. It's like sticking a band-aid on a wound that needs stitches. And let's not mince words, inflation in the US is far from tamed. Price pressures are still eating away at any wage gains, making life increasingly unaffordable for the average American worker, especially in big-ticket areas like housing, healthcare, and education. The Boeing effect, sure, the official tally says, business as usual, here with those 32,000 jobs bouncing back and placing a temporary floor under transportation equipment manufacturing. But underneath, we know that supply chain strangulations and delays are still punishing the sector. And this has long-lasting impacts as other industries like automobiles and tech manufacturing rely on a smooth supply chain of aircrafts and durable capital equipment. The political minefield. And who could forget the impending clashes over government hiring as President-elect Donald Trump's agenda threatens to slash federal bureaucracy? This has been the one saving grace for the labor numbers, folks. Government hiring has propped up much of the labor recovery post-pandemic, but what's going to happen when that faucet is turned off? Mass deportations and tariff warfare, if these come to pass, that's going to shave off an enormous amount of productive capacity from various sectors, especially agriculture, construction, and even tech. Corporate America may cheer at less regulation, but when you yank federal demand away, you sever a critical jobs engine. Even in the aviation sector, who can guarantee that Boeing's temporary fixes will last? From friction points in trade policies to pent-up bottlenecks from disrupted supply chains, it's all still lining up to disrupt hiring sooner or later. So, what happens next? Well, a lot depends on several key factors we're keeping an eye on. A. Job openings and labor turnover survey. Jolts with job openings ticking up in October despite layoffs easing, it's still possible that demand is normalizing, but not necessarily in a good way. A sustainable labor market is one with broad, rising demand across sectors, not just pumping up healthcare and hospitality jobs. Watch closely to see if open positions start dropping even further, particularly in manufacturing and retail. B. Consumer and producer price data. Whether inflation drops further might be our best gauge of how much space the Fed has to move. Remember, inflation over 3% erodes real purchasing power and puts more pressure on the central bank to act. C. Business confidence and investment patterns. Every major company, from Cargill to General Motors, is still announcing headcount reductions. Slicing workers is often the first move when executives lose confidence in future growth, but the bigger moves will be delayed investments in capital, technology, and infrastructure. That's when we risk tipping into outright recession territory. And where does that leave us? Here's the truth, any talk of a soft landing may be delusional. This moderated labor market doesn't mean it's time to celebrate, it means we're navigating the most precarious tightrope yet. We have a choice to make, keep glorifying short-term employment gains and sugar-coated metrics, or start addressing the complex reality, an economy marred by subpar wage growth, rising long-term unemployment, weakened domestic demand, and an uncertain global landscape. Until next time, keep your eyes on the numbers, don't fall for the headlines, and remember, the devil's in the data, folks.